Welcome to SB Talks. Today is Wednesday, August 2nd, and I'm joined as ever by our trusted Chief Investment Officer, Nick Ryder. Welcome, Nick. Welcome, everyone. Now, I'm going to start locally if we can. Yesterday, we had the latest decision by the Reserve Bank of Australia, and we had the third pause of this rate hiking cycle. What have you taken from that announcement?
Well, I think it was always going to be a line ball decision. So 20 out of 36 economists had expected another rate rise. But I think the data that came in over the last couple of weeks, particularly on retail sales, which were soft in June, and obviously the CPI print for the June quarter, which was a little bit lower than expected. Those were probably enough ammunition to give the RBA reason to pause.
Just pause to contemplate. The last time it we recorded was only a week ago, and it was a few hours before that latest inflation print. So perhaps we could delve into that, start there. What do we see in those numbers, and why might it give a little bit of hope that inflation is waning?
Well, the headline rate of inflation came down from 7% in the March quarter to 6% in June quarter. Trimmed mean, which I've spoken previously about on the podcast, the RBA's preferred measure of underlying inflation was 5.9, which was less than expected, and less than the RBA's own forecasts, which were at 6%. So it was at the margin encouraging. I think it's important, though, to kind of dive into the detail. And we saw further easing of goods inflation, which is something I've spoken about previously. You know, some of those supply chain problems are being cured, so the price of goods and demand for goods has eased. So goods inflation eased from, I think it was 7.6% to 5.8% year on year. But more concerning is probably what happened with services inflation. So that actually ticked up from 6.1 to 6.3. So that's accelerating. And that's really been driven by childcare, restaurants, international travel and accommodation, insurance. And those things are more tied to employment and wages.
Yeah, so and wage pressure is getting passed through to the consumers there.
That's right, and they're kind of not really heading in the right direction. And the RBA did give a nod to this in its statement yesterday, saying that services inflation is more of a problem, and they've seen this also internationally. So some people had expected that maybe was enough to push through another rate rise, but it wasn't. Also in the inflation report, rent, another big driver, it rose 2.5% over the quarter. That's the highest since the late 80s. So on an annual basis, 6.7%. So, and that's a big part of the CPI basket.
And there had been concerns there with the immigration doors opening up again after post-pandemic that was going to put supply pressures on the marketplace there, and possibly that's it now playing out.
It is. And we also know that those award wage decisions, the minimum award, etc., only kicked in 1 July. So we really haven't seen that wage pressure start to flow through into prices yet. So I think, that possibly pushes the RBA to maybe be on hold until we get maybe the Q3 inflation reading. And that might mean another rate rise in November, which is what some economists are saying. They've just pushed things back a little bit.
Well, you've been saying for some time, we are definitely entered into the territory where we're becoming data dependent.
Yes.
There've been, with the change of governor coming, announced, I think, since the last time we spoke with Philip Lowe, has one more meeting to go in early September, then Michelle Bullock takes the reins. And there had been some speculation whether he'd want to get some rate increases through before handing over. Well, he hasn't done that. He's been a true, I guess, an appropriate governor/economist and is going on the data, and it's probably a bit of a line ball call from here.
That's right. I think each meeting is live. I'd say the hurdle for another rate hike is probably higher.
Particularly if we go back to where we were, I think, in early June or May, where there was the speculation that another 2 or even 3 rate increases may be on the way. We've certainly cooled a lot from there.
We have, but I would say that the RBA retains a tightening bias. So they did say in the statement yesterday, some further tightening of monetary policy may be required to ensure inflation returns to target in a reasonable time frame.
Some references there to 2025 being the reasonable time frame.
Yeah, and that's 2 years away. So we'll get a new set of forecasts from the RBA this Friday. And that's expected to show inflation only coming back into the 2 to 3% target range in late 2025. So another 2 years for things to play out. So, is that a reasonable time frame? Obviously, it is. But I think they're concerned that if they don't see progress towards that, then there'll be more rate rises.
Yeah, are we at least heading in the right direction and heading towards there? So, as you say, month to month, we'll be watching closely from here, but possibly a little breather for those borrowers out there.
Yeah.
And some interesting core logic data we were speaking before in terms of some of the property sales that we're seeing and potential concentration towards recent purchases actually being making up a large portion of properties coming back to the market.
Yeah, so actually the RBA did give a nod to, I guess, the dispersion in households. So there are some people obviously being squeezed, and we've seen that in some of the core data, property sales data that's showing houses purchased in the last 3 years coming back onto the market. So 10% of transactions were those houses, and sometimes they're coming back on at a loss for the vendor. But then he also spoke about other households that are doing quite well because rising house prices, still elevated savings, and people like many of our clients getting higher income from their deposits and things. So that part of the community actually benefiting potentially from what's going on. So it's a very sort of split household sector.
Yeah, no, it's a real swing back. If we had a decade of quantitative easing and free money, essentially, which essentially benefited borrowers over savers, the pendulum has swung back quite aggressively. And as you call out, these rate rises are certainly not impacting all households equally. So really trying to look at the edge of the economy and see where the impacts are being felt and what that means in terms of the broader health. But RBA clearly cautious about going too hard and tipping us over the edge into a rapid slowdown. So we'll see what the inflation data and the broader economic data brings from here. I might stay on that theme if we're talking central banks. Since we last recorded, the Fed also made its latest announcement, and they kept on keeping on. They've moved on from their hawkish skip, pause, step, whatever it was, and back with another 25 basis points and really getting to quite a significant rate there. They're now in that target range of 5.25% to 5.5%. Looking at some of the numbers before, that's the highest rate that they've been at since probably prior to the GFC. And even then, it was only for a short period of time. It's getting back closer to where the rates more commonly sat in the early 2000s. So they're really determined to crack on with this job in terms of crushing inflation.
They are, but, I guess, like the RBA, they're now much more data dependent. Some people had thought they would do an every other meeting, and so this was there was a pause, as we know, and then they put through a well-telegraphed rate hike in July. From here, it becomes, like the RBA, much more data dependent.
What are we seeing in the US in terms of inflation?
So we had a good inflation print there in June. Core inflation came in a little lower than expected at 4.8%. So that's under the cash rate now. There were some encouraging signs there, but Chair of the Fed, Jerome Powell, said it was only 1 month of data, and at 4.8, it's still much higher than their 2% target. So they've got a bit of work to do to get back there. And he did call out that usually central banks do need to create some pain in the labour market to get inflation back to target, and they haven't really seen that. Like Australia, they've got a very strong employment market. Wage growth is still tracking at around 5%, depending on which measure you look at. So they've still got a bit of work to do, and but I think they're more encouraged around the soft landing narrative.
Yeah, so that's coming back onto the radar as a more optimistic outcome.
Yeah, certainly, Chair Powell, that had been his view that a soft landing was possible, and he reiterated that again at the press conference last week, and other Fed officials are also sort of coming around to that view that it is possible for inflation to come down, that immaculate disinflation that we spoke about on the last podcast, where inflation comes down without creating a lot of pain in the labour market. But I think it's still early days in that story, even though the equity market seems to have grabbed onto that theme quite aggressively.
Yeah, quite a bit of optimism there, and we might come back to that in a moment. But Let's keep transiting around the world. We've also had, since we last spoke, further announcements from Europe, Central Bank, and Japan. What are we seeing there?
Yeah, the ECB also delivered a well-anticipated 25 basis point rate hike to take their deposit rate to 3.75%. That's the highest since 2001.
Right.
From here, it's like the Fed and the RBA more data dependent. Christine Lagarde at the press conference, mentioned the possibility of a pause at September, which is their next meeting. She also called out, some progress on inflation, particularly goods inflation, but that services inflation is still a problem. And their core inflation numbers really haven't come down that much. So the latest print remains steady at 5.5%, so not even kind of falling at all. So they've got more work to do. But then the European economy is still fairly weak. It's more manufacturing based, and we know goods manufacturing's been fairly weak. So that's
a lot of complexities in there with the Ukrainian conflict, energy supply, grain supply into that market. It's not just a central bank. It's not a single lever that's been operated in there.
And they have low unemployment too. It's 6.4%, which is high by our standards, but low by theirs. And wage growth is also quite strong. So they've got the same problem with services inflation that we have and the US has as well. And we also had the Bank of Japan meet last week, and they kept the cash rate at negative 10 basis points, but they did tweak their yield curve control.
So what does that mean for our listeners?
Yeah, so they had pledged, going back before last year, they had pledged to keep the 10-year bond yield at around zero. They were no longer able to kind of maintain that. So then they widened the range, and last year they moved it to a range of 50 basis points, where they would tolerate the 10-year bond yield going up to 50 basis points. And last Friday, they said, 50 basis points is not a hard limit, it's more a guide. We're going to have more flexibility to maybe allow bond yields, 10-year bond yields, to go up to 1%. So 1% has become the de facto new kind of cap there.
So the return to some sort of normal long-term interest rate in Japan.
Yeah, so it's obvious that they're gradually trying to dial back the yield curve control and position themselves that if inflation does remain high there by their standards, that they have flexibility to change policy. So they've got inflation running at 3.3%, which in Japan is very high by
they've been working for a long time to generate some sort of inflation. So it almost is a cause for success there that they managed to achieve it. Yeah.
Yes. So they're happy to see a little bit of inflation, but I think a lot will depend on what happens with wage negotiations probably next year.
Mm-hmm. Now, I might come back to that point you mentioned before. US equities in general, optimism in equities, full stop. It is reporting season, as we spoke to last week. We're a little bit further into it now. What are we seeing? Sort of mixed results?
I'd say they've been pretty good. Obviously you get some companies that beat by miles and some that disappoint. By and large, we've had 60% of companies report, and the results have been pretty good. 80% have beaten, 16% have missed expectations. And
as you pointed out last podcast, the companies are typically relatively conservative in their estimates, so you would hope and expect a majority to beat.
Yeah, so the average in a normal earnings season is about 70% beat. Yeah, okay. So we're running ahead of that at the moment.
So certainly not a cause for alarm.
No, and we've seen some pretty good results. We've seen some misses, but on the whole, it's been pretty good. The average company's beaten by about 6%. Earnings are expected to be lower this year than the same quarter last year, but that's all due to energy, materials, and healthcare, which were, obviously this time last year were doing very, very well. And
anomalies in their high earning levels last year.
That's right. So if we cycle those out, people are expecting, the back half of this year to be pretty good for earnings, to have troughed and then kind of recover into the back end of this year. So there's a degree of optimism that's built in to market pricing. I would say companies that have beaten haven't necessarily seen their stock prices rewarded this earnings season, whereas those that have missed have seen their stock prices punished.
They've been harshly punished, which tells an interesting story in itself. That tells a story of a market that is optimistic about growth and pricing in a degree of growth and probably riding reasonably high on confidence, particularly as you described before, that soft landing scenario becoming closer to, I guess, almost the default scenario for some. It does seem to be dividing some of the commentators. Some suggesting this is a platform for markets to sort of kick on. Some others suggesting valuations are certainly now stretching the reality. Where do you lie in between those two camps?
Yeah, so I've been, I guess, more in the soft landing camp, and I think if that does play out, then equities continue to do well. I think we've seen a bit of frothiness, particularly in the last 2 months. So cyclical stocks have done really well versus defensive, as you would expect, as people sort of price in the soft landing. So there's a bit of frothiness there, but I think it's fine for now. But relative to bonds, equities are starting to look expensive.
So you remain, I guess, cautiously optimistic,
Yeah.
but increasingly see the value for bonds to come back and play a role in portfolios, particularly as we get closer to their terminal or peak interest rates.
Well, that's right. I mean, I think a 4% 10-year bond yield in Australia and the US is reasonably attractive. So, yeah, more optimistic on bonds. Probably looking to maybe take a bit out of equities at some point if the rally continues. Just some tweaking, really. So we'll see how it plays out over coming months.
Excellent. A very thorough run through as always, Nick. Thank you very much. And thank you to all our listeners. Take care and we'll speak again soon.
Thank you.